Welcome back to the Political Brief. Today, we're looking at a congressional hearing that may sound like dry banking policy, but there's a much bigger issue underneath it. How prepared is America's financial system when things go wrong? We're talking about community banks, access to credit, Federal Reserve coordination, and changes to credit scoring that could affect millions of Americans. And as you'll hear, there are some reasonable reforms being discussed, but also some serious questions about how much power and complexity Washington should add to the system. Let's get into it.
Gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to the witnesses for joining us this afternoon. For decades, the Federal Home Loan Bank System has served as a reliable source of liquidity for small community banks, credit unions, and insurance companies across our districts. By ensuring these institutions have dependable access to funding, the system has helped support local lending and expand access to credit for families, businesses, and communities. Much of this important work has taken place behind the scenes, making it easy to overlook the critical role the system plays in maintaining the strength and stability of our financial system. That is why I appreciate the opportunity to examine the Federal Home Loan Bank System today. This hearing gives us the chance to evaluate what is working well, identify areas where reforms may be needed, and consider the role Congress must play in ensuring the system remains resilient, transparent, and well-positioned to meet the needs of the financial institutions and communities it was created to serve. Ms. Naman, one of the major priorities of this committee over the past year and a half has been improving coordination among regulators to ensure a more timely and efficient supervisory process for American financial institutions. In your testimony, you discussed the, quote, efforts to improve coordination during periods of stress, end quote, between the Federal Home Loan Banks and the Federal Reserve System. Could you elaborate on the steps that have been taken to strengthen that coordination and whether there are additional opportunities to improve it?
Sure, thank you for the question. When we did our report, these efforts were really at the beginning stages. What we heard from the Federal Home Loan Banks and the Federal Reserve System were efforts to increase their engagement with each other. For example, doing tabletop exercises to practice reallocating collateral from the Federal Home Loan Banks to the Federal Reserve. Also actually testing the transfer of that collateral. We also heard about a working group that was established to increase standardization across the different Federal Home Loan Banks and the Federal Reserve Banks. The failures really highlighted a very complicated overlapping system of relationships between Federal Home Loan Banks and their local Federal Reserve Banks with different types of agreements, different types of procedures, and this working group was established to try to standardize some of those things. So we do not have an update on the status of those efforts, but we really believe it's important to continue those.
Thank you for that. Do you see a role for Congress in ensuring continued coordination between the Federal Home Loan Bank System and the Federal Reserve System?
That's not something that we had a recommendation on. Nothing is really coming to mind as a role for Congress in that. I think it was in the hands of the agencies to really continue that coordination. If additional oversight is showing that those steps are not continuing to be taken, then there could be a good role for Congress to step in and ensure that the coordination continues.
Thank you for that. Turning to you, Mr. Donovan. In 2018, President Trump signed legislation to modernize the credit scoring models used by the government-sponsored enterprises. After hearing from me and many of my colleagues, FHFA Director Bill Pulte and HUD Secretary Turner announced in April that they were moving forward with implementing these modernized credit score models at both enterprises and the Federal Housing Administration. Several federal home loan banks, including Dallas and Chicago, have already taken similar steps because modernizing credit scoring increases competition and innovation, improves risk assessment, and helps lower borrowing costs for consumers. I recognize that each federal home loan bank establishes its own collateral policies. At the same time, the banks are part of a single congressionally chartered system with a shared mission. As more banks adopt these modernized credit score models, it is important that member institutions have a consistent and predictable framework for assessing liquidity across the system. As enterprises begin accepting mortgages that use modern credit score models approved by the FHFA, how important is it for member institutions to have reasonably consistent access across federal home loan bank districts to liquidity backed by those otherwise eligible mortgages?
I think it's critical for our members to have options and for banks and credit unions, insurance companies, CDFIs to have options across the system. I know that many of the banks are looking at the VantageScore scoring model, and I'm also aware that banks and credit unions, mortgage originators across the country are also looking at that. So we're taking steps in the right direction, but it's critically important for there to be options.
Thank you. I'm out of time with that. I yield back, Mr. Chair.
What stood out to me immediately was Congressman Timmons' focus on coordination between the Federal Home Loan Banks and the Federal Reserve. Now, this may sound like bureaucratic jargon, but it's actually extremely important. The Federal Home Loan Banks provide liquidity to institutions like community banks and credit unions. These are the financial institutions that many ordinary Americans depend on, particularly outside the major financial centers. So when Timmons asks what happens during a financial crisis, he's asking a very practical question. Are these institutions actually prepared to work together when the pressure is on? The witness explains that regulators have started conducting tabletop exercises and even testing the transfer of collateral between the Federal Home Loan Banks and the Federal Reserve. And frankly, that's something that should have been happening all along. You don't want government agencies trying to figure out their procedures in the middle of a financial crisis. You test the system beforehand. You find the weaknesses. You fix them. And then you test them again. That's basic preparation. But here's where I think conservatives should pay attention. The witness also describes a complicated system involving different agreements, different procedures, and overlapping relationships between the Federal Home Loan Banks and the Federal Reserve Banks. That's a warning sign. America doesn't necessarily need another giant government program to fix that. It needs government agencies to actually communicate with each other and do their jobs properly. Washington has a tendency to respond to every problem by creating another layer of bureaucracy, another office, another regulation, another committee. But sometimes the solution isn't more government. Sometimes the solution is making the government we already have work better. And then we get to the issue of credit scoring. Timmons points out that the government has been moving toward modernized credit scoring models, with institutions looking at alternatives such as VantageScore. I think the basic idea here is worth supporting. Financial technology changes. Consumer behavior changes. The economy changes. So why should Americans be stuck with outdated methods of determining whether they're financially responsible? Competition between credit scoring models can potentially improve risk assessment and give lenders more information. And if that ultimately helps responsible borrowers access credit at better rates, that's a win. But there's an important line we shouldn't cross. Modernizing credit scores should not mean lowering standards just to make borrowing easier. We've learned the hard way that easy credit isn't automatically good credit. If somebody can't afford a loan, giving them that loan doesn't solve their financial problems. It can make them worse. So the goal should be better information, not artificially lower standards. And that's where I think the conservative position is pretty straightforward. We should encourage innovation. We should encourage competition. We should remove outdated government barriers. But we should also demand responsibility. Banks should manage risk responsibly. Borrowers should understand what they're signing up for. And regulators should make sure the system is stable without micromanaging every financial decision. I also think Timmons makes a legitimate point about consistency across the Federal Home Loan Bank system. If these institutions are operating as part of one federally chartered system, financial institutions should have some degree of predictability when it comes to accessing liquidity. You shouldn't have a situation where a bank can rely on one set of expectations in one part of the country and encounter completely different procedures somewhere else. Predictability matters. But again, we need to be careful about the answer. The government doesn't need to control every decision. It needs to establish clear rules, enforce them fairly, and allow financial institutions to compete. That's the balance. And there's another point here that I think gets overlooked. The witness was asked whether Congress should play a role in ensuring continued coordination between the Federal Home Loan Banks and the Federal Reserve. The answer was essentially that the agencies themselves should handle the coordination, while Congress can step in if oversight shows that they're failing. I actually think that's the right approach. Congress should oversee. Congress should ask difficult questions. Congress should investigate failures. Congress should demand accountability. But Congress shouldn't try to run every technical operation of the financial system from Capitol Hill. That's not what lawmakers are there to do. Their job is to make sure the institutions are functioning properly and that Americans' interests are being protected. And if those agencies aren't coordinating properly, Congress should absolutely demand answers. Because when financial institutions fail, regular Americans don't care which bureaucratic agency was responsible. They care about their savings. They care about their mortgage. They care about their business. They care about whether they can still get credit. That's why preparedness matters. The boring technical exercises being discussed in this hearing could actually be some of the most important work regulators do. Because you don't wait for a crisis to discover that two agencies can't agree on how to transfer collateral. You discover that problem during an exercise when there's still time to fix it. That's smart government. And that's the kind of government intervention I can support. Not endless bureaucracy. Not government trying to pick winners and losers. Not politicians deciding who deserve a loan. Just clear rules, competent oversight, accountability, and room for the private sector to operate. Because at the end of the day, the purpose of this system should be very simple. American families should have access to a functioning financial system. Small businesses should have access to capital. Community banks should have access to liquidity. And responsible borrowers should have a fair opportunity to obtain credit. But we shouldn't sacrifice financial responsibility just because politicians want to boast about expanding access to loans. More loans aren't automatically better. Better loans are better. That's the distinction Washington needs to remember. So my takeaway from this hearing is pretty simple. Modernize where modernization makes sense. Improve coordination. Test the system. Demand accountability. But don't use every weakness as an excuse to expand Washington's control over the economy. The private sector should remain the engine of American prosperity. Government's job should be to make sure the financial system is stable, transparent, and fair, not to run it. And if lawmakers can keep that principle in mind, reforms like the ones discussed today could actually help Americans instead of simply creating another layer of Washington bureaucracy. If you enjoyed this breakdown, make sure you subscribe to the Political Brief, hit the like button, and tell me what you think in the comments. Do you think America's financial system needs stronger federal oversight? Or does Washington already have too much control? I'll see you in the next one.